Welcome to the deep dive. Now, we know you operate right at that intersection of corporate flexibility and global mobility.
Huh.
Your focus is always on connecting people, business travelers, entrepreneurs with the right extended stay solutions.
Right. Service departments, hotel.
And crucially, serviced office spaces. It's all about making that live and work abroad model seamless, especially across the Asia Pacific region.
Absolutely.
So today's mission is tailored very precisely for those strategic concerns. We're looking at something that starts in the UK, a technical property tax issue.
It sounds niche, but it really isn't.
Exactly. It's something that threatens to destabilize the entire financial model of the global serviced office sector. If a pillar like this wobbles in a market like the UK, well, it's going to affect supply, pricing, everything for your clients. Okay, let's unpack this.
This is a perfect example of a tiny regulatory change having these just massive cascading consequences. The health of the flexible workspace sector, it isn't just about desks.
Yeah.
It's the infrastructure that supports modern corporate mobility. And if that foundation cracks in London, it sends a really negative signal across global markets. It immediately affects stability in places your clients operate, like Singapore or Hong Kong.
So let's define the threat. What exactly is happening?
Okay, so you have serviced office operators, the companies running co-working spaces and business centers.
Right.
They are, to put it mildly, sounding the alarm over new business rates calculations from the Valuation Office Agency, the VOA.
And for anyone not familiar with the UK system, the VOA is the government body that decides how much property tax businesses have to pay.
That's it. And the change is all in how they value the properties.
The methodology.
How did it work before? Well, before, the system made sense for the model. You'd have a big building with, say, 50 separate small offices inside, and each one of those offices, leased to a small business, was treated as its own separate unit for tax purposes. It was logical.
Okay, that seems straightforward. So what's the VOA doing now?
Well, this is what's so fascinating. They've radically changed their interpretation. They're no longer looking at the individual offices.
What are they looking at?
They're treating the entire flexible workspace, the whole building, all the offices, the shared kitchens, everything, as one single property.
One property. So that one pen stroke has, what, a couple of major consequences?
Two immediate devastating ones. And the second is the real killer for the whole small business ecosystem.
Okay, so what's the first?
First, the operator who leases the whole building suddenly sees their rateable value just skyrocket. Their base taxes go through the roof.
Right, because their one property is now huge. But you said the second consequence is the crucial one. What's that?
That's it. It affects the tenants. All those small and medium-sized businesses. When the building becomes one large property, those tenants instantly lose their eligibility for crucial tax reliefs.
Okay, let's drill down into that. Why? What is this relief?
It's called Small Business Rates Relief. It's a vital government subsidy. It either exempts or heavily reduces property tax for small companies.
To help them survive, basically.
Exactly. And your eligibility is based on the rateable value of the space you occupy. If it's below a certain threshold, you get the relief.
Ah, I think I see where this is going.
You've got it. By lumping 50 small offices into one massive property, the VOA pushes the value way, way above that threshold. So the small businesses are now, on paper, tenants of a huge, valuable property.
And so they're no longer small in the eyes of the tax system.
They lose the subsidy overnight, and suddenly they're facing the full, unmitigated business rate burden.
That's the critical point. So what was the industry response? I mean, this must have caused an uproar.
A coordinated one. We're talking about over 60 of the leading operators, some of the biggest names in the business.
And what do they do?
They wrote a joint letter directly to the Chancellor, Rachel Reeves, spelling out their urgent and deeply serious concern. This isn't just, standard lobbying. This is a sector fighting for its life.
You can feel the urgency. And what are the industry leaders saying publicly?
Jane Sarton from the Flexible Space Association, FlexSay, put it very starkly. She said this reclassification is, and I'm quoting, already putting the future of many workspaces in jeopardy.
So it's not a theoretical threat. It's happening now.
The financial reality is already biting.
Okay, let's put some numbers on this. What does this financial impact actually look like?
The scale is just staggering. We're talking an estimated over 150,000 small and medium-sized businesses across the UK losing this relief.
150,000.
Think about that. 150,000 viable small businesses suddenly hit with a massive, unexpected hike in their fixed costs. It puts a huge chunk of the UK's entrepreneurial base at severe risk.
And I assume even if the operators can somehow absorb the initial tax hit,
They're already warning they can't. They'll be
Mhm.
forced to pass those costs on to their tenants.
which comes at the worst possible time, right? With inflation, energy costs.
It's a perfect storm. It feels almost designed to accelerate business failures.
And then there's the part that turns this from a problem into a full-blown crisis.
The retroactivity.
The backdated bills, it's not just about paying more next year. It's about a sudden, massive debt from the past. I saw reports that some bills are being backdated by years.
With amounts reaching up to, well, the figure being reported is £400,000.
£400,000? I mean, that's
Hmm.
that's not a cash flow issue. That's a solvency issue.
It's instant bankruptcy for many. It's an immediate threat triggered by a retrospective ruling. You can see why the response is so ferocious.
Absolutely. So, given that damage, what is the VOA's legal justification? They can't just invent this. They must be basing it on something.
They assert it's based entirely on developments in UK case law. They're pointing to specific court rulings, things like Prosser v. Ricketts in 2024, Cardtronics v. Sykes in 2020.
Okay, so they believe they have a strong legal mandate, even if the industry disagrees. What's the core principle in those cases? What did they actually establish?
The central legal idea is something called exclusive occupation.
Exclusive occupation. What does that mean?
Generally, if a tenant has exclusive occupation of a space, meaning only they can use and control it, that space should be rated as a separate property. The VOA is interpreting these cases to mean that tenants in flexible workspaces do have that, which justifies treating the whole building as one entity.
But that's where the industry pushes back, right? This is their key counter-argument.
This is it. And it gets to the heart of what a serviced office actually is. Operators are firing back, saying their business model does not grant the kind of full, exclusive occupation that those rulings require.
How do they make that distinction?
They argue they provide a whole suite of services, not just four walls. There's centralized reception, shared security, maintenance, communal areas. The operator keeps a significant degree of control over the whole environment.
So it's a service package, not a simple lease.
Exactly. And they argue that this high level of retained control means it's fundamentally different from a traditional lease. Therefore, the case law just doesn't apply to their model.
So if we connect this to the bigger picture, it's not just about the tax, it's about governance.
Yes. The operators are accusing the VOA of making huge policy changes through the back door, using internal valuation practices instead of, proper consultation or new legislation. It just adds this massive uncertainty to a sector that's built on agility.
And that regulatory risk must be causing concern.
It's spreading fast. Other bodies, like the National Enterprise Network, are warning this could trigger widespread business failures, especially when these small businesses are still trying to recover from the pandemic.
So with this kind of threat, 150,000 businesses at risk, the focus has to be on political action now.
Entirely. The industry's united. They're demanding intervention. Experts like Tim Attridge at CBRE have said the whole business rate system is just outdated. It's not fit for the modern flexible economy.
It feels like they're trying to cram a 21st century business model into a 20th century tax definition.
That's a perfect way to put it. The system is clearly under stress.
So what are they actually asking for? What's the specific request to the government?
It's very focused. They're urging the chancellor to step in and halt these changes immediately.
Just pause everything.
It's a twofold request. First, stop the backdated bills that are causing immediate financial chaos. And second, suspend this new valuation method until the whole thing is properly settled in court.
They want legal clarity before the sector is dismantled.
Exactly. Not just by an internal VOA decision.
Okay, so this raises a really important question, and one that's directly relevant for you, our listener, especially if you're managing extended stay solutions in Asia Pacific. How does this very specific UK problem affect the global model?
Well, the serviced office sector is the essential.
Mm-hmm.
The plug-and-play solution for corporate teams that are relocating.
Right.
If the financial stability of that sector is destroyed in a key hub like the UK, the consequences are immediate and global. It's going to reduce the appetite for operators to expand. It will absolutely drive up prices everywhere as they try to mitigate risk.
And it must shake confidence, too.
That's the most critical part. It erodes the confidence of multinational companies who rely on these fixed-cost guaranteed solutions. The vulnerability of the model in the UK quickly becomes a risk factor for your clients planning assignments in Singapore or Hong Kong.
So what does this all mean? The big takeaway for you as a global provider is that a technical tax change is being seen as an existential threat, not just because of the tax itself, but because of how it's being done.
A sweeping change with no consultation.
And the result is a direct threat to the 150,000 small businesses who rely on this sector. It just highlights how vulnerable that essential infrastructure for global business mobility really is.
Hmm.
We've covered a lot. We've seen how reclassifying these workspaces as single properties is eliminating vital relief for small businesses, threatening 150,000 of them,
And triggering those huge, potentially fatal backdated bills.
all leading to these urgent calls for political intervention against the VOA's interpretation.
And that leads to a final provocative thought for you to consider.
What?
The industry's main defense, as we've said, is that they provide services that cancel out this idea of exclusive occupation.
Right.
So what happens if the UK courts ultimately side with the VOA? What if they decide that, yes, flexibility does mean the kind of permanent occupation that kills tax reliefs?
That would set a major precedent.
A huge one. This crisis highlights how important it is for you to be auditing the contractual language in your key Asia-Pacific markets. Do similar clauses about exclusive occupation or service provision exist that could trigger parallel tax disputes elsewhere? This could threaten the very foundations of flexible global work everywhere.
That is a crucial risk assessment and definitely one to track in the months ahead. Thank you for joining us for this deep dive. We'd encourage you to explore the original source material for all the financial and legal specifics.